Welcome to the eMortgage Management Hour, a straight talk show designed to give you the truth about mortgage financing in the greater Tampa Bay area. The views and opinions of your host, Scott Pendleton, and his guests do not necessarily reflect the views and opinions of WHNZ or its advertisers. And now, your host, Scott Pendleton.
How's everybody doing today? I am Scott Pendleton. Welcome to the eMortgage Management Hour, where E is for education. eMortgage Management is a licensed mortgage banking firm, NMLS number 2926, and all of our contact info can be found at tampabay.emmloans.com. Today I want to kind of talk about a couple of different subjects. We've seen some things change in the economy recently. We just saw history made a couple of weeks ago when the Fed raised the key interest rate up 0.25%. So I want to talk a little bit today about how that affects mortgage interest rates, or what we expect the impact will be on mortgage interest rates. And then I want to talk a little bit about what's your plan? What is your plan? What do you need to do to get ready to purchase a home? So we're going to talk about having a plan and what you need to do to get ready to buy a home. We're going to talk a little bit about mortgage interest rates and what the Fed impact will have on that. Real quick overview about eMortgage Management. We are a mortgage banking firm. We specialize in residential mortgages. We're not a bank. We don't take deposits. We don't sell CDs or other financial products. We focus on one thing, and that's closing mortgage loans. If you have any questions regarding a refinance or a purchase money loan, feel free to visit us at our website, tampabay.emmloans.com. You can also call us at the office. The number is 813-517-0795. We're available pretty much all the time. That number, when nobody's in the office, actually rolls to my cell phone. So you can pretty much get a hold of somebody in the evenings, weekends. We're always there to answer your mortgage-related questions. A little brief introduction about myself. I'm a 16-year veteran of the mortgage banking industry. I've seen the highs, I've seen the lows. Focus really on relationships, customer service. I'm also a veteran of the United States Coast Guard. I really enjoy working with vets and doing VA loans. So, my goal is really to educate the consumer. When you come to me and we have a conversation about what you need to do to qualify, what mortgage product is best for you, we're going to talk about it from an educational standpoint. I'm not going to push you into a product. I'm going to give you some options. We're going to talk about what and why might a product, what or why might make a product better for you. There are certain circumstances where there's only one product you qualify for. So, and you'll know the whys behind that as well. So with that being said, kind of getting into today's first topic, the Fed raise of the key interest rate 0.25%. People keep asking me, I keep getting this question, well, hey, you've been in the mortgage business for a long time. The Fed just raised the rate. What's going to happen? What's going to happen with mortgage interest rates? And, the real answer to that is nobody knows for sure. We can speculate, and I've been reading up on this and doing the research, and I have my ideas and my thoughts on what's going to happen. You have to understand, it's been 10 years since the Fed, it was June 2006 when the Fed dropped the federal interest rate to 0%. So it's been a long time. They did that to bolster the economy. And the good news is it's had some positive effects. I think economically right now, most people would tell you that we're in a better position than we were 10 years ago. When I talk to people in various different industries, obviously when you take a mortgage application, you take a lot of personal information. When I'm talking to people in different various industries, I'm seeing positive growth, and that's a good thing. So, the question becomes, is it a good sign for the economy that the Fed went ahead and raised that interest rate by 0.25%? There's mixed response out there to that. Personally, I think it's a good thing. I think for a lot of reasons. I think from a retirement standpoint, for those people that are saving for retirement, money in your 401ks and things like that, as the economy improves, as the Fed raises the key interest rate, it should be a positive or should have a positive impact on your savings. I know me personally, I'd like to retire one day. And the only way I'm going to be able to do that is by setting money aside via my different vehicles of saving, whether it be a 401k, IRAs, cash value life insurance, things of that nature. Those are the tools that I use to build a nest egg or a retirement, and with a little bit of an increase in the key interest rate, that should help those things. I think the good news also is out there that the Fed is going to take things slow. They don't want to take the train off the rails, let's say. They want to take things slow. I would be surprised personally if we see in 2016 the Fed mess with the key interest rate again. We got a quarter bump the end of 2015. I really don't think they'll do anything again in 2016. I think they're going to play it out, see how it affects the economy, and just let it go. Will it have an impact on homeowners and their ability to purchase? And the real short answer to that is, in the long run, yes. The key interest rate will trickle down to mortgage interest rates. To be perfectly honest with you, the first day or two of the increase to the key interest rate, we saw a little bit of a dip in mortgage interest rates. They don't necessarily coincide. But over time, I think the impact of the increase could be as much as a half of a point to a point in the next year to 2 years. That's strictly my opinion, based on the research and the reading that I've done. I think that's a pretty consistent opinion throughout the industry. So let's talk a little bit about what does that mean to you as a home buyer. I'm in the market. I want to purchase a home. If rates today are 4% and they go to 4.5% or 5%, what does that mean to me from a dollars and cents standpoint? So, I'm a mortgage guy. I'm a math guy. I look at things, from a real simple perspective, and that is being that math doesn't lie. So we can take a look at just for simple math, a $200,000 purchase with 5% down. And let's just use that as an example so you guys can kind of wrap your mind around what is a 0.5% or 1% increase in mortgage interest rates mean to me as the consumer if I'm going to buy a home. So let's take that scenario. You've got a $200,000 purchase with 5% down. You're looking at a loan amount of $190,000. 5% of $200,000 is $10,000. So in that scenario, let's just look at the principal and interest payment. If you took a 30-year fixed mortgage at 4%, which is, give or take, depending on the loan program, probably about average of where we are right now. If you take that 4% interest rate on a 30-year fixed mortgage, you're looking at a principal and interest payment of $907 and a couple of cents, but we're just rounding off here. So take that $907. Let's take that same exact scenario. Let's say it's 6 months down the road and rates do bump up by 0.5%. So let's say we're at 4.5% on a 30-year fixed mortgage. You take that same $190,000 loan amount. Now you're looking at a principal and interest of $962. That's a $55 a month increase. Well, let's take a little bit further. Let's say a year down the road from there, maybe mid-2017, we do see rates start to creep up a little bit higher, and we're at 5%. I know that sounds like a high interest rate in today's environment, but we're going to talk about that a little bit in a minute as well. It's really not, but let's take that scenario at 5%. Now, $190,000 loan, 5% interest rate on a 30-year fixed mortgage. You'd be looking at a principal and interest payment of $1,019. So that's $112 more than the original 4% interest rate at $190,000. So you're going from $907 to $119, $119, I'm sorry, $12 increase. Now, I know most of you out there could find $50 to $100 in your budget on a monthly basis very, very simply with maybe a few less visits to Starbucks, maybe one or two less lunches out on a weekly basis. you can easily find that $55 to $100. So I personally believe unless we see a tremendous increase in interest rates, mortgage interest rates, it's going to have very, very little impact on the housing market as a whole. I think money is still very cheap. Homes are affordable. Although we are seeing homes start to increase in value, which is a great thing. If you are a homeowner, you want to see appreciation. That's another thing that to help you get to that end game, to that retirement phase in your life, some of that equity and appreciation in your home. But, we all have to remember that we're seeing rates right now at crazy, crazy historical lows. And we're spoiled. You have to put things into perspective. So when I talk about perspective, we're spoiled, but I think we're spoiled in a good way, right? We've seen, some good economic growth the last couple of years. We've seen mortgage interest rates at low interest rates. It's given the average guy out there the ability or the capacity to afford more house. So you can get a nicer home for you and your family. And to me, that's an extremely important thing. It's what I do every day. I'm a firm believer in the dream of home ownership. There's something special about having your own house, having your place, where you hang your hat at night, knowing that if you want to paint the walls pink, purple, or green, they're your walls. You can do whatever you want with them. If you want to do an addition, you want to change things about your home, it's yours to do. So, there are expenses to owning a home. But I think in the long run, the expenses definitely outweigh the positives definitely outweigh the negatives. So, the biggest thing is obviously appreciation. When you're paying rent on a property, you're just putting money away. You're paying for somebody else's appreciation. You're paying for somebody else's nest egg down the road. Why not invest in yourself? The housing market has increased here at a decent clip. Realistically, I'd like to see things continue to increase at an interest, at an appreciation rate of probably around 3 to 6%. Maybe on a good year, you get 5 or 6%. On a bad year, you're seeing 2 to 3% appreciation. I don't know that it's healthy to have 15, 20% appreciation in home values. I think that's what got us in a lot of trouble, 10, 15 years ago. So, I think it's very important that we see nice, steady appreciation. But kind of back to my, original point, we're spoiled in a good way with rates as low as they are. And I'll give you an example. I spoke to a customer of mine, a guy I've done a mortgage for his daughter, owns 4 or 5 investment properties. A little bit older gentleman. If I had to guess, I'd say Jay's probably early to mid-60s. So he's been around for a little while. He owns these investment properties, and all of them are sitting in an interest rate range of 6 to 6.5%, let's say, in the low sixes. Now, most of us look at an interest rate like that and we go, oh, my God, that's such a high interest rate. When the reality is, from his perspective, he looks at that and he goes, 6, and he's like, his perspective, he's like, I've got good interest rates on these properties. I don't know that I want to mess with them. The conversation I had with him, I said, look, let's look at each individual property and see if there's an opportunity. Now, these are investment properties, so, the rates are the terms are a little bit different on investment properties than an owner-occupied residence. But I said, let's sit down, have a conversation, and talk about these properties. Yes, 6.5 is a good interest rate. Maybe we can get you a little bit lower based on today's market. But the interesting thing to me was his perspective. He thinks that's a good interest rate. And the reason that he thinks that's a good interest rate, because historically he's used to, because of his age and because he's been around, he's older, a little bit wiser, he's used to much higher interest rates. And just to give an example, I did a little bit of research today before I came on air, and I looked at some historical interest rates. So just looking back 10-year increments, if we look back to 2006, so 10 years ago, the average interest rate on a 30-year fixed mortgage was hovering right around 6.25%. Now, this is a range. On a monthly basis, you could see that fluctuate a little bit, but that's about the average. So we're sitting at about 6.25%. You go back 10 more years from that, 1996, the average interest rate was 7.03%. I remember the first house my wife and I bought together long time ago. I'm getting a little bit older, a little long in the tooth. The interest rate we got, I want to say, was 7.5%. And we were happy. We were ecstatic with that interest rate. We were like, wow, that's a great interest rate. Once again, it's all perspective. The market bears what the market bears. Go back another 10 years to 1986. Now you're looking at an interest rate of 9.45. That's average. Now, another interesting thing about when you get back to that 80s time frame, a lot of our older family members or parents or grandparents, it wasn't uncommon for them to see interest rates in double digits, 11, 12, 13%. The other interesting fact on that is when you look at those interest rates, those high 10, 11, 12% interest rates back in the 80s, it wasn't just the interest rate. They were also paying points, sometimes up to 1.5, just 2 points, just to get that 9.5, 10% interest rate. And you don't really see that in our market today. We don't see people paying points. And when I say points, lenders have the capacity to charge you a percentage points up front on your loan. Sometimes they just charge you points so they make more money. Sometimes they charge you what are called discount points. Discount points are used to buy down your interest rate. Because the market has been so fantastic over the last several years and rates have been so low, you don't really hear about people using discount points or discount to buy down their interest rate. Pricing is very compressed, and rates are incredibly low anyway, so there's not that much room to go. Back in the 80s, it wasn't uncommon for somebody to pay points to buy down their interest rate. Especially when you're talking about the average loan size back then was a lot less than it is today. Obviously, average sale prices have gone up, average loan sizes have gone up. But when you look at that scenario, back then, paying 1 point, so let's say, just for simple math, $100,000, 1 point would be $1,000, 1% of $100,000. Paying that point might save you 0.75 of a point in interest. So over the long term, that's a pretty good investment. If you think you're going to be in that house for a long time, dropping your interest rate by 0.5% to 0.75% saves you a lot of money in the long run. Today's market, pricing very compressed, rates extremely low. It's rare that there's such an opportunity to benefit from buying down interest rate. So, some of the things to kind of think about as well with interest rates, you've got a lot of different products out there. 15-year fixed mortgages, for example, on average run about 0.5% lower interest rate wise. Having good credit has a huge impact on the rate that you're going to get. We talk about this on the show from time to time, and we talk about different loan programs. So when you talk about a conventional loan, just a standard conventional loan, most conventional loans require 5% down. When you look at that scenario, conventional loans are very, very credit score driven. So the guy with a 740 credit score is getting a much better interest rate than the guy with a 640 credit score. There's something called loan level pricing adjustments. The industry looks at risk, and the lower your credit score is, they've already done the calculations. They know if your credit score is in the 640 to 660 range, they're going to have X amount of defaults on those mortgages. And they know that the higher the credit, the less defaults they have. So it's all risk-based pricing. So when you're looking at potentially purchasing a home, whether it's going to be later this year, next year, or right away, one thing you need to do is make sure you start to pay a lot of attention to your credit. You young people out there, you millennials, I cannot tell you how important your credit is. I urge you to take the time to research your credit and know what your credit score is. It makes a huge impact on your ability to buy a home. Then you've got, once again, so that's kind of that conventional world. Now, the good news is the federal government, or HUD, created a product called the FHA loan. The FHA loan is less credit score driven, let's say. It's designed for first-time home buyers. It's more liberal when it comes to credit scoring. Typically speaking, if you've got a 640 or better credit score, the guy with a 640 score and the guy with a 740 score in an FHA loan pretty much getting the same interest rate. and the rates are better than conventional loans. On average, maybe 3/8 to 0.5% better for somebody with decent credit on an FHA loan. They are, those loans are insured by HUD. So, you're putting a little bit less money down. You're getting a little bit better interest rate. Now, there are some negatives to FHA loans. There's mortgage insurance. If you do an FHA loan, you're going to pay mortgage insurance. And unfortunately, with the new FHA guidelines, you're paying that mortgage insurance for the life of the loan. So that's something to think about when you're looking at that, scenario. Is an FHA loan better than a conventional loan? And once again, we want you to use us as the insider. I spout off this information on the radio from time to time, and you maybe catch a little piece of it. But I'm here to answer those questions for you down the road. We're the Mortgage Insider. All you got to do is call us. Our number's 813-517-0795. We're here to help you. We're here to help you keep more money in your pocket. And for us to be able to do that, we have to have a conversation. So I urge you to look us up, tampabay.emmloans.com. Call us at 813-517-0795, and let us help you. Let us help you keep some of that money in your pocket and explain to you why maybe an FHA loan, even though the rate might be a little bit lower, isn't necessarily the better loan for you. Now, if you do have not so perfect credit, then maybe in that scenario, the FHA loan is the better option. So when we start talking about that mortgage insurance, once again, on the FHA loan, it's for the life of the loan. That doesn't mean you can't refinance and maybe get out of it down the road. But when you refinance, there's costs, closing costs involved in that. And ideally, you don't want to have to do that, especially if you have a very good low interest rate. Conventional loan, if you put less than 20% down, you're going to pay mortgage insurance. The mortgage insurance changes a little bit, the cost of the mortgage insurance, depending on how much you put down. So the mortgage insurance, if you're putting 5% down, is going to cost a little bit more than the mortgage insurance if you're putting 10 or 15% down. It goes in 5% increments from a cost standpoint. And same thing with mortgage insurance. Very much like a conventional loan, it's driven by your credit score. So on a conventional loan, if you have very, very good credit, the mortgage insurance isn't going to cost you as much. If you don't have great credit, then the mortgage insurance is going to cost you more. And that's when we have that conversation and go, you know what? Maybe in your situation, the FHA loan is the better deal. Now, of course, you've got the VA loan. You heard me say earlier, I'm a veteran of the United States Coast Guard, how much I love the VA loan. The VA loan's phenomenal. If you're eligible for a VA loan, even if you've got 5, 10, 15, 20% to put down, that VA loan still, in my opinion, is probably a better option for you, even if you've got great credit. The rates are lower on VA loans. If you're not putting 20% down, it doesn't really matter because there's no monthly mortgage insurance on a VA loan. It's a phenomenal loan product. The one thing that the government finally got right is the VA entitlement or the VA loan benefit for us veterans out there. It's one thing that they nailed it. It's a great loan product. The VA loan limit goes up to the $417,000 conventional loan limit, and it gives you a lot of options. You can put no money down, 100% financing, have no monthly mortgage insurance, and get a rate very comparable to FHA, a very, very low interest rate, typically, like I said, on average 3/8 to 0.5% lower than a conventional loan. So it's a phenomenal loan product. We love doing VA loans, and we love working with veterans. With that being said, there are going to be some examples where a VA loan may not be the best option for you if you're putting a big chunk of money down. Probably the only real negative on a VA loan is there's an upfront funding fee. So depending on if it's the first time or the second time you've ever used your VA entitlement, you will pay an upfront funding fee. So that's just something to keep in mind. But once again, you don't have to remember all this. We're here to answer the questions for you. tampabay.emmloans.com. You can call us at the office at 813-517-0795. We're there to answer those questions for you, to keep you in the loop. You don't have to remember everything I'm telling you right here today. So we're going to take a quick break here in just a couple seconds. When we come back, we're going to talk a little bit about planning. What do you need to do to get ready to purchase a home? And, so hang tight with me. Come back after the break, and we'll discuss what you need to do so you can buy a home this year.
And now, back to the eMortgage Management Hour and your host, Scott Pendleton.
Welcome back. So, as we said in the last segment, I told you we were going to talk a little bit about planning for a new home purchase. As you're thinking about whether it's time to purchase a home, whether it's 3-6 year down the road, it's important that you have a plan and a budget put together so that you can be ready to purchase a home. I can tell you from my experience, from talking to realtors out there and doing this for quite a long time, the first step in the process is calling me. You need to talk to a mortgage broker, a mortgage lender, a mortgage banker, and find out what you qualify for. It's very important to know what the numbers are today. It's very important to know what your credit looks like today. The earlier you start the process, the better. If, for example, we pull your credit and we find some things that maybe aren't perfect, which happens a lot, maybe it's of your accord or not of your accord. Maybe there's mistakes on your credit report, which happens a lot. We need to know about it earlier in the process so we can work on it and get it corrected. It's important to have that information ahead of time. You don't want to be under contract on a property, closing in 30 to 45 days. You haven't been pre-qualified. You go, you talk to a mortgage banker, they pull your credit, and they go, hey, what's this? I noticed that you've got this collection here for $3,000. Did you know about this collection? And you're going, what? It says here that you had a $3,000 medical collection. Does this make sense? Oh, well, yeah, I did. I was in the hospital 2 years ago, but I had health insurance, so I don't understand why there'd be a collection. Well, let me tell you, that's probably one of the most common things we see. People that have health insurance, that have medical collections, and they have no idea that they're there. So it's very, very common that when we pull credit for people, we find little things, little mistakes. You know, if you heard me in the first segment and we're paying attention, I said it's very important for you to pay attention to your credit. You know, I recommend everybody pull their credit at least once a year. 6 months, every 6 months is better, but at least once a year, you need to look at your credit to see if there's anything on there that doesn't look correct. Maybe a late payment that's showing that really wasn't a late payment. We see that sometimes. There's a lot of little things that can sneak up and nip at you when you're in the mortgage process and throw a wrench in the works. So we don't want that to happen for you. So it's very important that you get with a mortgage banker early in the process. Let us pull your credit. Let us look over your income documentation, and let us give you a real number and say, okay, listen, Bob, here's where you're at today. Here's what you can afford based on this. And if Bob comes back and says, well, gee, Scott, you just qualified me for a $200,000 purchase, but I really want to buy a $300,000 house, that's okay. Here's what we've got to do to get you ready to buy a $300,000 house. Here's the debts you need to focus on. Here's the debt that's going to have the most impact on your overall debt-to-income ratio so that you do qualify for a $300,000 house. Or here's what you need for a down payment. All those things, that's all part of that conversation. You know, once again, it's all about information. We're the mortgage insiders. We're here to help you. We're here to answer those questions for you. All you got to do is go to tampabay.emmloans.com. Call us at 813-517-0795. We're available to answer those questions for you. One of the other big things that seems to be or can be a sticking point in the beginning when we start talking about the mortgage process is where is your down payment money coming from? So, you know, we are in a mortgage lending environment today with the Patriot Act and things of that nature, where as an investor, as a lender, as a banker, we want to know where that money's coming from. And when we see large deposits, for example, going into your bank account, we don't like that. We want to know that it's good, clean money, that it wasn't from, you know, terrorism or drug deals or anything like that. So lenders don't like cash. I just had a conversation recently with a customer, and they have quite a bit of cash set aside, which to me seems kind of scary. I don't know that I'd want large amounts of cash in my house, but that's neither here nor there. This particular client has a lot of cash, and I had to have that conversation with her. I was like, listen, she said, my husband, her husband's foreign, old school, likes to have his money, at home. Okay, that's fine. I get it. Don't trust the banks. Everybody's a little bit different. Who am I to say? But as I explained to her, I said, I can't just take $50,000 cash deposit in your bank account and run with it. My underwriter's going to they won't allow it. They're going to ignore it. They're going to pretend it's not there. They don't want to see that money. So with that being said, if you have a plan and you're prepared, and maybe you are that old school person, maybe you do have cash laying around. Maybe you're a bartender or waitress and you work on a tipped environment. You come home every night. I know I worked in the restaurant business for years in my 20s. Ran restaurants, did that whole thing, and I knew a lot of the wait staff and bar staff that worked for me. A lot of them would go home and they'd take their tips and they'd set it aside, and they'd build up that cash and build up that cash. That's fine. It's all about having a plan, because, as a mortgage banker, we're going to look back at 2 months. So if you're going to buy a house in the next 3 to 6 months, get the money in the bank today, because I'm only going to look at your last 2 months' bank statements. If that money was there prior to that, I don't know anymore. I'm only seeing the last 2 months. That money's in your bank. It's seasoned. And I don't have to stress out about where it came from. It was already there. So, once again, that's talking to a mortgage banker early in the process, having a plan, and using the plan. Another big question that comes up, so you go through that process, you go meet with your mortgage banker, and he says, okay, Bob, you qualify for this, and here's what you need to do, and, your credit looks good, or, hey, you know what, there's 2 little things that we need to get cleaned up. Here's my recommendation. Here's how I can help you do that. We can help you sometimes remove things from your credit that need to be removed, or get them updated, or do credit supplements. That's a big part of what we do. Once we get to that point, really then it becomes, where do you want to live? So, for example, I talk to people that are moving into the area on a regular basis. Somebody new moving to the Tampa Bay area that hasn't lived here before. When I have that conversation with somebody, I talk to them, I say, listen, you've never lived in Tampa before. You're moving from Chicago or New York or Wisconsin or whatever the case may be. That's all great. You don't know where you want to be. My recommendation to that person is rent for a few months, rent for 6 months, maybe even a year. Move to the market, figure out where you want to be. Where do you want to live? Are you a young family? Are you young and single? It's going to make a big difference on where you want to live. I live in the West Chase area of Tampa. I have a wife and a daughter, middle-aged professional guy. Great area for me. I love it. There's a lot to do. A lot of like-minded people. Fits my demographic very well. Now, if I was 25 years old, single, and didn't have any kids, there's probably living in the West Chase area probably is not where I'd want to be. I'd probably want to be in South Tampa, Hyde Park. There's a lot of different places where, I would probably want to hang my hat. So, you got to figure out where you want to live. There's a lot of ways you can do that in this day and age. We have this World Wide Web out there, and there's tons and tons of information. Zillow is a phenomenal site for real estate. I don't make any money by saying that. I think Zillow is just an easy, no pressure way for somebody that's just getting in the market to see what's available out there. Get on Zillow, start looking at some homes. What is that $200,000 or $300,000 budget buy me in the market that I want to be in? So I've decided, I've talked to a mortgage banker and kind of gotten my budget. Here's the payment that I can afford. Here's the price range I can afford. Now I've kind of figured out, all right, I like this area, and this area. Now I can go in the comfort of my own home on my phone or my tablet or my computer and go, all right, let's look on Zillow. What is $300,000 buy me in this area, this area, this area? Then the next step to there is I think it's very important to hire a real estate agent. And you hear me talk about this on the show a lot if you've ever heard this show before. One of the things I say all the time is make sure you hire a full-time professional realtor. There's a lot of realtors out there in the market that do that job as a part-time profession or a hobby. Hire a professional. You wouldn't use a part-time doctor. You wouldn't go hire a part-time lawyer. When you're hiring a realtor, go hire a full-time professional and hire somebody that's not trying to pressure you into a market or a area or a home. You want kind of a no-pressure agent. And you got to remember, when you're a buyer, when you're buying a home, that real estate commission is paid by the seller, by the listing agent on the listing side. So that person that's listing that property, that seller, they've already negotiated that commission. And out of that commission, your buyer's agent will be paid. So for you as a home buyer, there's no cost associated with using a realtor. So you've got the capacity to interview 2 or 3 agents, pick the one that you think is best for you. I'm happy to help you with that as well. We work with what I feel are some of the best agents in the market, and I'm pretty good at putting personalities together. You know, we're always willing to help you. You can give us a call at the office at 813-517-0795. We can get you pre-qualified. And then if I know you're looking in a specific market, I can say, listen, here's a great realtor in that market, knows the market like the back of their hand, no pressure, somebody that'll work with you, that you'll enjoy working with, that will help you find the right property. So that's kind of the next step. You gotta find the right agent. And if you're trying to buy a home out there without using a real estate agent, I think you're hurting yourself. Trust me, the realtor that's listing a property would be extremely happy if you walk in to buy that property without a real estate agent, without any representation. That way they control the transaction. They keep 100% of the commission. They don't have to split it now. So they make more money, and they have more control. But remember, their client is the seller. You're just a transaction to them. So as a buyer, I recommend you hire a professional buyer's agent, somebody that's going to work with you and hold your hand and take you through the process of finding the right home. So, you know, and you know, the other aspect of that is, you know, when you're working with an agent that knows a market, you know, if you're younger or if you have children, they're going to help you with, you know, what school district you need to be in. They can give you information about the schools, about local organizations. So they really can provide a lot of information for you. So I cannot reiterate enough how important it is for you to have that agent. So, you know, kind of going back to that plan, it's really all about, you know, getting pre-qualified early in the process, making sure you know where your down payment money is coming from. When we go back to that down payment money, here's the good news as well. It doesn't necessarily have to be just your money. We allow gift funds. So let's say that mom or dad are willing to give you a gift for your down payment. Almost every loan program that we work with allows for gift funds. It's very rare that they don't. So, you know, your down payment can be a gift. If you're getting a VA loan, you don't have any down payment. So there are definitely ways that you can get that money. If, for example, and I wouldn't say this is choice number one, but let's say you've done a great job with saving over the years and you've got money set aside in a 401k. I would normally tell people, you put that money away in a 401k and you never touch it. It's there for retirement. The only caveat to that is if you really, you know, are, you know, ready to purchase a home, the only option, you know, the only time I would recommend taking money out of your 401k would be for the purchase of a home. And most 401ks make accommodations for you and allow you to kind of borrow the money against yourself with no interest and no penalties. So you can take money out of your 401k for down payment and closing costs on a home. And we have clients that do that on a very, very regular basis. It's something that happens all the time. So, you know, and then you have to, you know, it always goes back to, you know, is it better to buy versus rent. And that's a conversation I have with people all the time. And, you know, everybody's got their opinion. Once again, you're new to the market, new to the area, I'd say in the beginning, rent. Figure out where you want to be. Find the right area for you. But a couple of things about, you know, whether it's better to buy versus rent. So a couple of things that come to mind. Number one, if you buy a home and you use a 30-year fixed or a 15-year fixed mortgage, you've got a fixed payment. You know, rents typically rise with inflation. So that's something to kind of keep in mind. You know, as opposed to renting year after year after year, giving somebody else equity in a piece of property, you're building equity and building wealth, hopefully. It's all really what this is about, building wealth. And you've got a fixed payment. Your principal and interest payment on a 30-year fixed mortgage will never change. So while everybody else is paying rent and the rents keep going up, your payment stays the same. You're building wealth. You're seeing appreciation. Plus, it's your own. Like I said, if you want to paint the walls a different color, if you want to remodel, that helps. You know, another thing, kind of a hidden cost when you rent and you move all the time. Every time you move, you've got kind of a different layout in a property, right? So maybe that furniture that you have today doesn't fit in your new rental. So you've got to go buy, you know, new furnishings, new decorative items, new things like that, new curtains. You know, when you own a home, I've been in my home for over 10 years. The furniture in my house is pretty much the same furniture we had that we bought when we moved in 10 and a half, 11 years ago, with the exception of a few items here or there. But, you know, I haven't had to really buy new furniture because I haven't moved. You know, nothing's really changed. We've updated some things, but, you know, that was because my wife wanted to update things, not because we had to. Another big part of that is mortgage interest is tax deductible. And I think that's something that people forget, especially if you're young and single. You don't have any deductions. You know, you don't have any kids. You don't have any tax deductions. It's important to remember that mortgage interest is tax deductible. So the interest that you pay on that mortgage on a monthly basis, you're going to get a form from the IRS at the end of the year that says, okay, you had this mortgage. Let's just use an example here. So let's say, for example, you had a $175,000 mortgage and your interest rate is 4%. You're going to get a note at the end of the year that says you can write off X amount of interest. At a federal tax rate of 25%, if you're in a 25% tax bracket, your first year tax savings is $2,173. Equates to about $181 a month. So when you do the math, it saves you money to buy just in interest deduction. You know, plus you're seeing appreciation. So now you've got an extra $180 a month in your pocket, maybe a little bit bigger tax refund at the end of the year, money that you can do something with, maybe go on a nice vacation, whatever the case may be. But that's money. That's real money. That's money in your pocket. So what I like to do a lot of times when we start talking about rent versus buy and whether you're ready or, you know, if you're thinking about making a plan to buy, I like to kind of give some real life examples. So, you know, we deal with a lot of purchase transactions in our office and we talk to a lot of customers. So for me, the best way to do that is by looking at real life scenarios. So just to give you some real life scenarios, we just recently closed a loan for a couple in Tarpon Springs. An FHA loan, purchase price of $149,000. In that scenario, on a $149,000 purchase, they put the minimum down payment on an FHA loan, which is 3.5%. So in that scenario, 3.5% down equated to $5,215. Okay, so they're getting a $150,000 property. Now this property was a 3-bedroom, 2-bath home, 1,444 square feet. Okay, so they're getting a 3-bedroom, 2-bath. Comparable rent, the rent that they were paying was $1,040 prior to this. And I don't know the details of the property they were renting. I'm pretty sure it wasn't a 3-2. I think it might have been a 2-2. But in that scenario, they were paying $1,040 in rent. Their mortgage payment on their new home is $977.94. The moral of the story is they were paying more in rent than they are to purchase a property, 3-bedroom, 2-bath, 1,444 square feet. And if you're renting an apartment, 1,444 square feet's a big apartment. You know, they got a single family home. That's a big difference. and that's in Tarpon Springs. Now, obviously, different areas, different home prices. Let's take a little bit higher. Let's look at a property in Palm Harbor. We just did a deal recently on a property in Palm Harbor. It's a townhome. $299,500. $299,500. So, obviously, pretty nice townhome. It was a 4-bedroom, 2.5 bath, 2-car garage, 2,174 square feet. Decent size home, townhouse, nice property. I saw the pictures of it. Haven't been to the property yet. Saw the pictures. Great property. That was they put 10% down on that property. So, substantial down payment, $29,950. They had a nice chunk of change to put down. And we're looking at a payment in that scenario of $1,882. Now, I don't know where you can go rent a 2,200, 2,100 square foot property for $1,800 a month. Not in Palm Harbor. It's not happening in Palm Harbor. Great school districts, some of the best high schools in the area. Palm Harbor U. I've got nephews that go to that school. Great school. It's a beautiful area. Palm Harbor is a very, very nice area. Look at maybe an area like Land O'Lakes. Go a little north. Get up to Land O'Lakes. So here's a scenario we just did recently in Land O'Lakes. $199,900. $199,900 out the door. Basically a $200,000 purchase. This particular couple, they put 3.5% down. So in that scenario, $69,997. Now remember, that down payment doesn't have to be their money. It can be a gift. We're not going to get into the down payment assistance programs today, but there is opportunity for down payment assistance programs for lower income families. So there are ways to get the money. But in that scenario, once again, purchase price of $199,900, 3.5% down. Their rent was $1,200. Now, this property is a 4-bedroom, 2-bath, 2-car garage property. Nice home, 2,012 square feet, good size home, and their mortgage payment's $1,377. So it's a great payment. A little bit more than they were paying in rent, but a lot more house. Nice big yard, great property. So another good example, we did a VA loan. I always like to give a VA example, right? Riverview, we did a VA loan, $207,000 purchase. How much down? $0, 0% down. Typically, when we do VA loans, most of the time when you purchase a home, in case you don't know this, you put an escrow money deposit. Usually about 1%. So on a $200,000 house, you'd put a $2,000 escrow money deposit. With the way that the VA loans work, if you negotiate for the seller to pay your closing cost and you're getting a 0% down mortgage, you're not having to put any down payment. Generally speaking, on a VA loan, when our borrowers go to closing, they're getting their escrow money deposit back at closing. So instead of coming to closing with money, they're getting money at closing. So in this scenario, these people were paying $1,500 a month in rent. The property they purchased was a 3-bedroom, 2.5 bath, 2-car garage, 1,900 square feet. So once again, nice home, 3 bedrooms, 2.5 baths, Riverview, nice area, affordable area, and their mortgage payment's $1,409 a month. Now, once again, one of the big pluses of the VA loan is there's no monthly mortgage insurance. So, those are just a couple of examples of what we're seeing, real-life examples of what we're seeing in the market, deals that we're seeing that are closing on a daily basis. We've got a team of people in our office that are there to help you. I'm here to help you. I've got 4 or 5 other loan officers that are available to help you. I've got 2 full-time processors in my office that will happily answer any questions that you have. So it kind of goes back to that information and education and what gives you power. You're not going to remember everything that I said here today. The real goal is for you to use us as a tool. That's what we're here for. We're the mortgage industry experts. We're the insiders. We want to help you keep more money in your pocket. So give us a call. Pick up the phone. It's 813-517-0795. Go to our website, real painless, tampabay.emmloans.com. You can do an online application in the comfort of your home. There's tons of information on our website, checklists, information, mortgage calculators. Trust me, there's more information out there than you can shake a stick at. So I look forward to hearing from you. Thanks for listening to the show today. Make sure when you're thinking about a mortgage, you think about eMortgage Management.
You've been listening to the eMortgage Management Hour every Sunday at 11 a.m. on 1250 WHNZ. If you'd like to contact Scott Pendleton, you can call him at his office weekdays at 813-517-0795. That's 813-517-0795. Or for more information about eMortgage Management, click on tampabay.emmloans.com. Thank you for listening.